These Dow stocks will top the 2024 scoreboard. A strong buy case can be made for each of the stocks here. Microsoft. AI development will continue this year, prompting growth for Microsoft. Coca-Cola. Amid falling interest rates and a reasonable valuation, Coca-Cola could outperform its more expensive peer companies. Johnson & Johnson. Its numerous growth avenues will deliver shareholder value. Let's dive in. Dow Darlings. Here are the top 3 stocks that will lead the charge in 2024. Welcome to Timely Investment Research. The Dow Jones Industrial Average is up 3.64% over the past month, and technical indicators show that it could extend much further. If last year's repeat of the Majestic 7 leading the broader indices again happens this year, we could be in for a bit of a wild ride. Despite their stretched valuations, tech stocks will continue to deliver growth for investors this year. Also, we may see a lengthier composition of stocks compared to 2023's rally. With lower PE ratios and falling bond yields in response to predicted interest rate cuts, some underappreciated Dow stocks could rise further. Let's examine 3 of those Dow stocks that may emerge as winners this year. Number 1. Microsoft. Microsoft is one stock in last year's Majestic 7 with plenty of energy reserves. Thanks to heavy investment in OpenAI, it's a leader in the generative AI race by proxy. We witnessed generative AI move from strength to strength in 2023. It began with its release and then progressed with GPT-4 and GPT-4 Turbo. Some analysts predict GPT-5 could be on the cards mid to late this year. The newest GPT models are still far from reaching artificial general intelligence levels, comparable to a human's level of reasoning. Still, if the roadmap of previous AI models is a reliable indicator of future rollouts, we can expect GPT-5 to be significantly better at reasoning than GPT-4. Also, a likely feature would be to expand its context window to allow for longer prompts. This is an area in which other AI models like Anthropic's Claude presently have an entrenched advantage. It's natural to assume that Microsoft will be the first beneficiary of the developments that OpenAI releases to the public. Currently, it's providing an edge over its peers of companies like Alphabet and Amazon. AI progress may accelerate this year and beyond, which will give some buoyancy to Microsoft's stock price. Number 2. Coca-Cola. Just as I am bullish on tech stocks this year, I am also fond of defensive sectors such as consumer staples and healthcare. This brings us to Coca-Cola. This is one of those companies you could park your money in and forget about for 20 years with minimal stress. First, if the indices continue to rally, these blue-chip dividend kings and dividend aristocrats may be a valuable hedge. At the same time, investors take more risk elsewhere instead of betting the whole farm. Secondly, the valuation of these brands is reasonable, with Coca-Cola stock trading at just 24 times earnings. Investors who seek income may also return to dividend stocks like Coca-Cola in the midst of falling interest rates. Coca-Cola doesn't offer the most attractive yield, but it's still solid at 3.08%. From a dividend investing perspective, owning this company may be ideal for those with a long time horizon. They will benefit from its strong dividend growth rate of 3.36% over the past 3 years. Due to its defensive nature, the worldwide, iconic Coca-Cola is arguably worth a spot in every investor's portfolio. Number 3. Johnson & Johnson. Johnson & Johnson is another great defensive play. Investors are unfairly underestimating its potential due to its pending talc litigation. The reason I believe it's unjust is because Johnson & Johnson has already put aside $9 billion as it anticipates the legal costs. Therefore, the risk is contained. Also, Johnson & Johnson's investors consider it a defensive stock, as some of its largest operating segments lie within growth-based industries such as medical technology and pharmaceuticals. This blends the best of both worlds, which many low-beta stocks like Johnson & Johnson lack. At present, Johnson & Johnson is undervalued on an earnings per share basis as per its long-term averages. Additionally, it may be undervalued according to its forward and historical growth rates. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.